Good afternoon. I'm Ross from Lifetime Property Accounting, and we're going to look at what is interest limitation and why is it so nasty? Why do we hate it so much as property investors? So I'm going to share my screen and we'll go through some basic numbers. So say you've got an older rental property, and this is under the old interest limitation rules. We don't know if they do come in exactly what those rules will be. But based on the old rules that were around a couple of years ago, um, if it had a fully come in at 100% interest limitation and you had an older rental property, in general, you might have had income something like 30,000 a year, for example. Interest expense for this example, 25,000, and then you've got your rates, your insurance, your repairs, your property manager, all your other expenses. I've put 10,000 in there, for example. So a lot of property investors, those expenses at the moment with interest rates about 4.5%, 5%, and not actually covering the income in a lot of cases. So they're actually making a cash loss of about $5,000 a year. So rather than actually making money, they're having to fork out about $100 a week, about $5,000 a year for an average sort of rental property. And obviously, everyone is different. So then what happens if interest limitation is in place and we're not allowed to deduct any interest? We're then not allowed to deduct this key expense. We're not allowed the interest. So we've got 30,000 less 10,000 expenses. We're making a $20,000 taxable profit. So even though we're losing 5,000, we've got a taxable profit. If you're then on the 33% tax bracket, that's 6,600 tax to pay. So you're losing 5,000, you then have to pay 6,600 in tax. You're overall losing 11,600. This is obviously massively unfair. Like, how do you lose money and then pay tax as well? Yeah, and where does this money come from? Where do you pay the tax from if you're already losing money? Where does the cash come from to pay tax? So normal situation, you'd make a profit and then you would pay tax on that profit and you'd have the cash from the profit to pay for the tax. So let's just have a compare. Let's see yeah, what this compares like with lots of other businesses and things like that. So we bring in business, farming, forestry, some overseas shares, commercial property, new residential. Under the old interest limitation rules, all of these could claim their interest. So I've done them all the same. Let's say they've all got 25,000 of interest. They've all got 10,000 of other expenses. Cash profit, they're all losing $5,000. Well, for business, that's a $5,000 loss for tax. So you can probably offset that against other income, get a tax refund, reduce your cash loss. Farming, forestry, overseas shares, commercial property, all the same. Depending on your structure, if you can, yeah, if you're structured and set up so that that loss is offsetting your personal income, you'd then get a PAYE tax refund. You'd actually get a tax refund rather than paying tax. New residential property is the losses are ring fenced, so you can't offset them against your PAYE job or your business income. So in general, you won't get a tax refund there. So yeah, the different things. So old residential property loses 5,000, pays 6,600 in tax. You're losing 11,600. Business, farming, forestry, overseas shares, commercial, same situation. They would only be losing 3,350. They would actually all get a tax refund. New residential rental property based on the old rules, no interest limitation. So they wouldn't have a tax bill, but they would not get a refund either. So they're $5,000 cash loss down. So the rent is not covering the expenses. They're still a loss. So hopefully that sort of explained the difference and why it's so scary for property investors that yeah, you can be losing money while you're paying a big tax bill and yeah, effectively end up worse cash flow. If we just change those around a little bit, and let's say you're making money. Let's say the interest bill is lower. It's only $15,000. And yeah, we'll just apply that across everyone else. So it's all the same across all of them. And yeah, pretty much impossible to get a low number of other expenses, something like 5,000 for a rental. But let's say it is only $5,000. Um, just going to move that slightly. And then, yeah, we've got the same across all the other ones. So in this case, we've got, yeah, a cash profit. So what happens in this point is they're all making $10,000. The business, the farming, the forestry, the overseas shares, commercial, new residential, um, they are all going to have tax to pay in this case of $3,300. So they're making $10,000 of cash, paying $3,300 in tax. They're left with $6,700. Yeah, the simple example, 33% tax. The poor old property investor with an older property. If interest limitation comes in, they've got the same $10,000 cash profit, but they can't claim that 15,000 interest they're paying. So they have to pay tax on 25,000. Their tax bill is then 8,250 instead of 3,300 for all the other asset classes. So they're making 10,000, but after paying 8,250 in tax, yes, 82.5% tax. We can work that out. So yeah, 82.5% tax bill on that one. Um, Bring that in. 82.5%. That is nasty tax bill. They're only left with $1,750 out of that 10,000. So yeah, really, really nasty. Obviously, last thing, if interest limitation does come in, what we'll be looking at is can we rearrange borrowings? So any borrowings over any of these is going to be tax deductible. So we'll potentially be looking, can we move the borrowings to new residential, commercial, overseas shares, farming, anything else, and have less borrowing over the older rentals so that, yeah, we're maximizing the interest that's deductible. So, yeah, at the moment, there is no rules. We don't know what government's going to come in. We don't even know if interest limitation is coming back in. So, yeah, there's not too much we could do now. And we could be in a situation where all residential properties are interest limitation, or it could be all commercial and all residential rentals have interest limitation. To me, I don't really know why new rentals have a different rule to older rentals. So it could be anything. So yeah, hard to restructure or rearrange at the moment. Under the old rules, yeah, we would have moved debt to any of these and tried to do that. Yeah, we need to see a little bit what is going to come in, exactly what those rules are before we can really do anything. So yeah, hopefully you found that useful. Hopefully that has been helpful for you. And yeah, we've got lots of other videos and things. Check out our Facebook, check out our YouTube, and yeah, lots of good information. Thanks a lot. Bye.